The top business stories live from the Sky News City studio. NHS England expands virtual wards offering hospital care, level care to thousands of people at home. I'll speak with one of the companies providing the service. Criticism of the Bank of England's inflation forecasting. Experts say it should have spotted red flags. And how AI is being used to combat sanctions busting at sea. Good afternoon. This is Business Live with Ian King. The NHS has announced an expansion of its so-called virtual wards, saying it will provide hospital-level care for tens of thousands of children at home. The announcement coincides with the Health Service's 75th anniversary today. NHS England says the hospital-at-home service is already the largest of its kind in the world and will now expand to cover every region of England. Well, Doccla is the leading provider of virtual wards for the NHS. Its Chief Commercial Officer is Tom Breeze, and he joins me now. Tom, welcome to you. For the uninitiated, what is a virtual ward?
Hi, Ian. Thank you very much for having me. So virtual wards basically exist to make sure that patients are only in hospital when it's clinically necessary for them to be there. And what happens is you provide patients with a box of devices and often clinical capacity to monitor patients' vital signs and ensure that patients are safe in their homes and can therefore be discharged early from hospital if they were already in hospital, or can remain in the community and have their condition managed there.
But can that always replicate the quality of service that one gets in a hospital ward?
So what's important to remember is that the sorts of patients that are being admitted onto these services are not the sorts of patients that would otherwise be in ICU. They're patients who otherwise would just have their symptoms monitored and be checked on by a nurse or a doctor, maybe a couple of times a day on a ward. So for those patients, actually what we're able to do by continuously monitoring their symptoms and making sure that those are intelligently checked, you could argue that they're receiving a more attentive service than they would otherwise be in a hospital. And of course, we can't forget the patients who are now able to be in hospital that otherwise would have been waiting for the service because of this additional capacity.
How do you get paid? Is it on a fixed term contract or is it on a per patient basis?
It depends on how our providers want to pay us. So we're very happy to basically do whatever it is that the local commissioner thinks is appropriate. Generally, that happens to be per patient rather than on a fixed term basis.
And roughly how much do you think you can save the NHS per patient?
Well, so a study done by the NHS thought that where Doccla was in use with one NHS provider, we were saving about £3 for every pound spent on the service. We actually think that number's probably gone up and is closer to £5 or £6, but £3 is the independent NHS delivered figure.
How have you managed to persuade the clinicians to adopt it? Because they can be quite a conservative bunch. They don't take kindly to their working patterns being disrupted, do they?
So the clinicians are fabulous. So what we typically see is that there are just extraordinary demands on clinician time. And you're right that as a consequence, sometimes it's hard to be able to free up time in their day to adopt a new service. But when you explain the benefits to patients, our patient satisfaction rates are about 99% genuinely at the moment. And you can play back some of the stories of what it means to be a patient on this sort of a service at home with a wife, with a dog, eating their own food, then generally we find it's pretty easy to get the clinicians on board. Of course, that it assumes that you have the time to speak with them in the first place.
Now, the rollout is going to be specifically aimed at children who are receiving treatment. You've done a few trials, I think, in Dorset and in Blackpool and in Dudley. What did you learn from those?
Yeah, so working with children is a really interesting issue, I suppose, because there what you assume is that these virtual wards have got to provide something that is capable of being understood by a 5-year-old. But actually what you see is that in reality, that 5-year-old is always having their care mediated by their parent normally, but by somebody else who might be involved in their care too. So we find that so long as you've got a really well onboarded, trusting relationship with the person caring for the child, then actually it works relatively seamlessly and smoothly like any other virtual deployment. So we think it's a great idea.
All right, Tom, got to leave it there, I'm afraid. Good to talk to you this afternoon. Thank you.
Fabulous. Thank you very much, Ian.
Just a bit of breaking news to bring you. There's been a second protest by Just Stop Oil protesters on Court 18 at Wimbledon. I think we can show you what's happened. Obviously, there was a disruption this afternoon earlier on at 2:10. Here is the latest.
It was the Dimitrov match earlier in the day, where there was a very similar protest.
That didn't look like the right clip, did it, somehow? Well, any time now, I'm told we will be showing you. Let's have a look.
Afternoon. And another disruption for the second.
Well, at least he didn't spoil the grass like they did at Lord's last week. Now, MPs on the Treasury Committee have been told that the Bank of England should have spotted red flags that inflation would have been higher than forecast. Stephen King from HSBC told the committee the signs were there in early 2021.
Others saw the first signs of inflation surprising on the upside against a background of seriously weak economic activities. Now, normally, when you've got seriously weak economic activity, you expect inflation to surprise on the downside. So the fact it was surprising on the upside, not just in the UK, but in the US and the Eurozone, suggested that something was changing relative to the history of the previous 30 years. And the second thing I would note is that if you move away from the model and think about some of the monetary indicators that were coming through at the time, particularly in the US, less so in the Eurozone and the UK, there was incredibly powerful money supply growth in 2020. Now, you might say, the relationship between money and the economy is not as strong as it once was, and I absolutely agree with that. But when you've got that kind of strength coming through, which is really off the scale of what we'd seen previously, that strikes me as being a red flag. It's an indicator that perhaps the model as it wasn't working as reliably as the bank itself had suggested.
Now, Russia's war on Ukraine has highlighted the importance of tackling sanctions busting, and nowhere is that more pronounced than in the maritime industry. Data suggests more than 2 in 5 of all high-risk tankers are affiliated to Russia, and there has been a rise in deceptive shipping practices by such vessels. Well, today saw the London Stock Exchange Group strike a deal with Windward, in which its LSEG workspace platform will make use of the latter's maritime AI-powered technology. Well, joining me now is Windward's Chief Executive, Ami Daniel. Ami, welcome to you. What are the kind of behaviours on which you hope to be able to pick up?
First of all, it's great to be here again. Good afternoon. It's very simple. Last week, you had the EU pass a very new and aggressive regulation banning vessels from entering EU ports and channels if they do basically one of 3 main things. One is turning off transmissions deliberately, what's called dark activity. The second is doing an unauthorized or unreported ship-to-ship transfer within 200 nautical miles of the coast. And lastly, spoofing their location, which is something we have a patent pending on, and we broke on the front cover of the New York Times. So these 3 things will be banning vessel entrance into the EU, and that's exactly the core of the collaboration with LSEG, where the 15,000 users or so of Workspace will be now able to know that real time and stay on the right side of the law.
And which sort of users are going to find this most valuable? Presumably it's risk managers and insurers, I guess.
Well, I think LSEG's customer base is commodity traders, charters, equity traders. So I think that's predominantly their crowd. We obviously also work with insurance companies, 7 of the 12, what's called P&I clubs, third-party insurance, and many, many others, about 170 of them currently. So I think it's becoming more and more important and more aggressive. And this EU regulation is not just talking about bulk trade, which is oil and grain and so forth, but also for the first time ever containerized trade. So really the Putin invasion into Ukraine has changed completely all the scene around trade compliance, what industry is or is not allowed to do, and who is industry. We signed last week the first contract with a pilotage company. So new sectors are brought into this trade compliance game because the EU has to find some way to enforce this oil cap, because right now it's not working that well.
Now, this is AI powered. What does AI contribute to the process?
Well, you have millions of activities every day in the world. You have millions port calls, turning off transmissions, a million problems with these transmissions, and AI is there to really sift through the noise and really pinpoint the real bad actors, if you will. The flip side of compliance is stopping trading. And I don't think in this economy anybody wants to stop trading, right? And traders definitely don't want to stop trading. So AI is there really to reduce what's called the false positives and make sure you actually make more business by using our software, not less business by using our software. And that's really one of our USPs versus really legacy companies and data providers. With AI, you do more business, not less business.
OK, Amit, got to leave it there, I'm afraid. Good to see you again this afternoon. Thank you.
See you soon.
Some other stories now. And the government issued debt today, paying a higher rate of interest than at any point in the last 16 years. The Debt Management Office, which is the Treasury agency that manages the UK's borrowings, issued a gilt, that's a UK government bond, which will pay investors an annual return of 5.668%. The gilt matures in October 2025. Well, a gilt maturing on that date was sold last month with a yield of just 4.874%, highlighting the extent to which the government's borrowing costs have risen sharply in a relatively short period of time, when investors offered to buy nearly 3 times as many gilts as were being auctioned, and the sale raised £4 billion for the government. The Financial Conduct Authority has confirmed for the first time that it's investigating whether hedge fund manager Crispin Odey is a fit and proper person to work in financial services. In a letter to the Treasury Committee, Nikhil Rathi, the SCA chief executive, confirmed the regulator had launched an ongoing investigation into Mr Odey and his firm, Odey Asset Management, 2 years ago. Well, Mr Odey was ousted from the firm last month after the Financial Times reported on a number of allegations of sexual misconduct, which he denies. The vehicle rental group Red Northgate has said demand is still outstripping supply as it reported record results. The company, whose importance in the white van rental market means it's seen as a barometer of small business activity, reported a pre-tax profit of £178.7 million for the year to the end of April. That was up 35% on the previous 12 months. Well, Red Northgate, which employs more than 7,000 people and which operates a fleet of more than 130,000 owned and leased vehicles, said it continued to enjoy robust demand. Now, the first half of this year was largely a good one for stock market investors. In the face of continuing concerns over the war in Ukraine, the impact of inflation and rising interest rates in most developed markets, and the ongoing trade dispute between the US and China rumbling in the background. But with all of those factors still in place, what does the second half of the year hold? Well, joining me now is Ken Fisher. He's founder and chairman of Fisher Investments. Ken, good to see you again. When we spoke last time, you were talking about what you call the midterm miracle, and you thought that would drive markets higher for the first half of this year. I mean, for those who weren't watching at the time, explain what you meant by that.
So if you go through stock market history, and the U.S. has the longest accurate stock market history data, since the S&P 500 data begins in 1925, the period that begins October 1st of a U.S. midterm election year is the most consistently profitable period over the next 9 months of all of stock market history, no exception. The midterms bring in gridlock, and gridlock eliminates political risk aversion fears because nothing big controversial gets legislated, which can take from these to get to those. The history of that 9 months is 92% positivity. That is positive 92% of all those periods, and with an average return of 20%. The midterm miracle this time in the S&P 500 worked almost perfectly, with each of the 3 quarters positive and the total positive 25%. The reality of all of that is that it usually ripples somewhat around the world because developed markets tend to correlate. That's a little different for Britain, but only a little different than some other countries because of the sectoral differences between the US and the UK, which are important to understand because each sector behaves in its own way. And we'll come back and talk about that. But that's the background for that. The aftermath of that's also very positive, and we can talk about that just a little less positive.
Well, so Ken, you think this effect still has some way to play through then?
Yeah, so when you go back through that long history, the back half is positive in the United States, a little over 75% of the time, which is much more than the average return for the stock market. And with an average return for the back half in total that looks like one of the first 2 quarters. Now, again, in Britain, that may be a little confusing because 2023 hasn't been such a great year in the market. But for the global market and for particularly big and particularly tech and particularly luxury consumer goods, you've had a gangbusters year.
Now, you obviously have a keen eye on history, because I note that you say that this year so far has been like 1967 in the markets. For people who weren't around there, what was so particular about that year?
So the 66-67 period is the closest period in parallels to the 22-23 period, in that you had a midterm election, you had a bear market in 1966 that began almost exactly when the 2022 bear market began in the calendar year, and ended almost to the day when the bear market in 2022 ended, beginning of end of September, beginning of October. You had out of nowhere spike in inflation and central bank hikes, and a foreign war in that case that was thought to be associated with all that, the escalation of the Vietnamese War. You had a U.S. president who had been very popularly elected 2 years earlier, and then had become increasingly unpopular, so unpopular that Lyndon Johnson could not get renominated in the fourth year of his term, 1968. But you had a 25% stock market year in 1967, in a bull market that began and went on after 1967, almost exactly to the day of when this bull market began, with a midterm miracle. The other thing to think about that is that the fourth year of presidents' terms, not only in the United States, but also, in fact, in Britain, is markedly above average, with above average positivity and above average returns. And that whole feature tends to run on through the third and fourth year of president's terms. And one final point, we haven't had a negative S&P 500 since 1939, as World War II was starting, and it was only down 0.9%.
Again, there's so much more I wanted to ask you, but we're out of time, I'm afraid. Good to see you, and hopefully see you again soon. Thank you.
Thanks for having me, Ian.
Still to come here on Business Live, we'll take you through today's moves on the markets. Don't go away.
We're about a month into the offensive now, and it's going okay. There's quite a lot of messages coming out from President Zelensky and others, just kind of, I think, counselling caution. It takes time, it's going okay, but it's not going fast, and nor should we expect it to be. The Ukrainians are trying to attack through very, very difficult Russian defences, and it's slow and costly progress. Well, I think what you're seeing is across the front, the very long frontage. The Ukrainian forces they're pressing, they're probing, they are making gains. Hanna Maliar, who's the Ukrainian deputy defence minister, said yesterday they took about 9 square kilometres the day before. I mean, that's a small amount of terrain, but it is forward movement. But I think what's actually going on is the thing you don't see, and that is kind of preparation in depth. So lots of, and we saw this last year as well, where the Ukrainians will be trying to prepare in depth. So they'll be trying to destroy Russian logistics, their command and control, which will make it easier for when they do break through. Well, the cost of human life, we've heard it from a number of people recently, just to manage our expectations. General Milley, the American chairman of the Joint Chiefs, said only a couple of days ago, this is costly warfare, and none of us should ever lose sight of that. When we're kind of looking on our Twitter feeds or whatever, the reality is for the soldiers on the front line, this is brutally difficult. I'm increasingly reminded of my own experiences in Mosul when the Iraqis liberated Mosul, and the offensive started with great fanfare in the world's gaze. But the reality is it takes a long time. It took 9 months for the Iraqis to liberate one city. And they did that with the world's or the West's air power and support. And of course, the Ukrainians don't have as much air power as they need.
fly Emirates, fly better. Fly Emirates, fly better.
European equity markets have finished the session in negative equity, with weak Chinese services data weighing on sentiment. All of the main indices in Europe in negative territory. Leading fallers include Casino, the debt-laden French grocery chain, off by 32% on news that a rescue refinancing is going to all but wipe out existing shareholders. Well, here in London, the FTSE 100 finished off more than 1% lower in a broad-based sell-off led by Chinese exposed stocks, most notably Prudential. Among other leading blue-chip fallers right now, the Pru off nearly 4% there, as you can see. Other leading fallers in the FTSE this afternoon included Legal & General. That's on news that accounting rule changes will clip profits this year by more than expected. There are not too many gainers to mention, as Legal's off 2%. Among the gainers, there weren't many of them, but the educational publisher Pearson up by nearly 2.5%. That's on positive broker comment. Outside the FTSE, the engineering contractor Keller Group is ahead by 12% on a trading update. But the building materials group SIG, that's off 11.5% after it warned this year's profits would be at the lower end of market expectations. On Wall Street, meanwhile, equities have opened to the downside after the 4th of July public holiday. The main focus is on the minutes for the latest meeting of the Federal Reserve's Open Markets Committee. The market looking there for clues on the direction of US interest rates. On foreign exchange markets, meanwhile, well, it's pretty quiet, to be honest. Sterling more or less unchanged right now against both the dollar and the euro. The oil price has been interesting today. That's clawed back most of its losses from earlier in the session, and it's now in positive territory. A barrel of Brent crude will currently set you back $76.58 a barrel. That's up a little under 0.5% on the session. Joining me now is Victoria Scholar, Head of Investment at Interactive Investment. Victoria, welcome to you. I mean, all eyes obviously on the FOMC minutes this evening.
Yeah, that's absolutely right. We've got the minutes from the June meeting due in just over an hour. And I think that the message is really going to be that more work needs to be done. Perhaps another 0.5 percentage point of more tightening this year could be needed stateside, even after the central bank kept rates on hold at its last meeting. And the suggestion really is that June was very much a skip rather than a pause or any kind of end to the rate hiking cycle, given that inflation still remains considerably above target, although it has come down quite a lot and is a lot lower than we are here in the UK. We could also see some discussion about the outlook for the economy and the potential for some weakness to come through in the data. And we know that the Fed likes to talk about the fact that it is led by the data, so that will be important too.
Do you think the dollar is, the dollar's not really moved this afternoon. Do you think all of this is priced in?
Yeah, I think a lot of this is priced in. You know, the Fed has been pretty clear in terms of its signalling when it paused in terms of rates. We did see some downside to the dollar, but it does feel as though there is potential for more upside if indeed we do see those rate hikes come through, or if we see any of the inflation data or the PCE price index, a closely watched measure of inflation, come in hotter than expected. And also if we get any signs that the labour market is also tighter than expected, because again, there could be those second round potential impacts on inflation, and that could lead to more monetary tightening.
Briefly, if you would please, Victoria, a bit of a risk-off day today, but Pearson was one of the leading gainers today.
Yeah, that's right. We saw that it was at the top of the FTSE 100 pretty much all day, rallying by over 2% after UBS raised the stock to a buy from neutral and increased its price target on the stock. It says that some of its divisions are, or the potential for gains within some of its divisions, such as assessments and qualifications, could actually do a bit better than expected. So it argues that some of that isn't being priced in yet. But last year it was really a stock market winner, but some of those gains have tailed off this year.
Very good. Victoria, got to leave it there. Thanks for joining me. That's it from me. I'm back tomorrow morning at 11:30. Hope very much to see you then. Thanks for joining me today. Cheerio.